This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 41. Evaluation and review. Near the end of the audit process, we must assess the number of areas before we can form an overall opinion. Overall review, other information, subsequent events, and going concern of particular areas to have particular attention paid. Auditors should carry out a review of the financial statements. The review should be sufficient in conjunction with conclusions drawn to give us a reasonable basis to arrive at and express an audit opinion. It will determine whether acceptable accounting policies have been used, and whether the information in the financial statements is compatible with our own audit findings. Adequate disclosure should have been made, and proper classification and presentation of information, consistent with prior years. If there is an inconsistency, that would require a prior year adjustment, wouldn't it? It would require the comparative figures to be restated so that they're then on a consistent basis with this year's presentation. It's a change in policy. It's a change in accounting policy and needs to be retrospectively applied. Financial statements need to comply with statute and other regulatory requirements. And again, the audit report in Devro, if you read it, the audit report says that they are in compliance with Companies Act 2006. Analytical procedures. We can use analytical at the overall review stage. We used them yesterday though, didn't we? What stage were we using analytical procedures yesterday? At planning. Where else? Throughout the course of the audit. Analytical review, this wonderful weapon that the auditor can use throughout the entire process of the audit. Before the audit, analytical review, you're bearing in mind, you're watching the local news, you're listening to the radio, you're reading the newspapers, and they do occasionally concern your clients. And you think, oh, that will have an effect on this year's figures. So even before the planning stage, analytical review is involved. Changes in government, military coups, overthrowing governments. The head of the government, is it the Democratic Republic of Congo, has submitted himself to the International Criminal Court. Somebody called Boise? I can't remember his name. I keep hearing it on the radio, but I can't work out what they're saying. That will have an effect, and directors of companies who are found guilty in court will have an effect on, and may have a retrospective effect on prior years, because if a director of a client company is found to be guilty of fraud, then the integrity and the reliability of prior year financial statements now needs to be called into question. Task is normally performed by more experienced staff. That's interesting as well. This is a analytical review, analytical procedures require a degree of expertise and experience. And the only way you're going to have expertise and experience is by allocating the work to experienced staff with that expertise. But how do you get that expertise? If you're not given an analytical procedure exercise to perform, because you've never done one before and therefore you don't have the expertise, how are you going to gain the expertise? Because you've still never done one. There has to come a time when someone says, yeah, okay, let's give the procedure to Thomas and see how he manages. See if he can do an analytical procedure review or an analytical review. See what he can find, but then we'll also do it, a separate manager will also do it. And it's the only way that people can gain and extend their experiences is by being pushed. Is it the Peter Principle? I think it is. Do you know the Peter Principle? People are promoted to a level where they are inefficient. People are promoted to a level where they are inefficient. Think about it. If you're good at your job, you get promoted. If you're good at your job, you get promoted. If you're not good at your job, you don't get promoted. So there I am at a level where I am inefficient. What should happen is when you get to the place where you are inefficient, you should then be demoted back to the level that you are competent. But it doesn't happen. People get promoted and very rarely get demoted. It's a sensible principle, isn't it? Just looking around the office here. Just wondering who's in positions now where they are inefficient. Think about your own office. Could you identify in your own mind, I'm not asking for names, people that you think are inefficient? I don't expect you to reply. Task is normally performed by more experienced staff because considerable knowledge and experience is needed to carry out the procedures effectively. At the final review stage of the audit of Turvisex, you find that the accounts receivable payment period has increased from 45 days to 50. This is a topic that could very well come up in P7, and you may find that you have to write a report based on a report on financial statements. It's more an F7 topic where you have to write a report, and what the examiner will more likely do is give you some information like that and expect you to find reasons why this accounts receivable period should have risen from 45 to 50. Give us some suggestions. Go on.
The customers may have some troubles with payments.
Yeah, customers may have trouble with payment, as in, for instance, Cyprus, where they can't get the money from the bank and they're not allowed to write checks unless it's to the supplier who has an account at the same bank. So you're just moving the money that isn't in the bank from one account to another. So yeah, there may be problems in making payments. Or it may be the customer themselves. It's a big customer, though, to move 45 to 50. It's a big customer when you're taking the total receivables balance, unless you're talking about a national financial crisis like in Cyprus. All right. Another one?
Maybe changing the policy of the company.
Maybe changing policy. Maybe we're extending the credit period in order to increase market share. And if that's the justification which is given, because don't forget, analytical only raises questions. You say to the directors, how come receivables has gone from 45 to 50? And you say, we had a change in policy. We had a change in policy in September. And we're giving customers now 90 days credit in order to build up our market share. Then you need to see, have sales increased in the last 4 months as a result of this change in policy? And that would confirm it.
The customer's structure changed.
The customer structure, the customer structure changed. Maybe we're no longer aiming for the do-it-yourself market. We're now selling to builders, and we're giving them that extra. So the do-it-yourself market would tend to pay cash, whereas the builders will take credit. Yeah, that's another one. Just generally, that I suppose it's the same point actually. That we used to be a cash sales-based company, cash sales orientated company, and we're swinging it around now to credit sales based. Yeah? Another one? Well, the simple one, credit control department is falling apart. Credit control department is not doing their job. Another one, that we've just this year become registered for sales tax, for VAT, for PVM. We've just this year become registered for sales tax. So sales will still be net, but the receivables will be inclusive of the VAT. And that will have an effect on the receivables collection. So you need to be prepared. Some people, when asked the same question, will say, we've had an increase in sales. That won't do it. An increase in sales will not have an effect on not itself have an effect on the receivables days. Initial engagements, opening balances. We need to ensure that opening balances do not contain errors or misstatements materially affecting this year's financial statements, and that appropriate accounting policies have been consistently applied. But if there has been a change in accounting policy, then that's been properly accounted for and prior periods have been restated. And comparatives agree with the amounts and disclosures in the preceding period, and they're free from errors that would impact on the current period. So the opening position, last year's balance sheet, last year's statement of financial position, is the start point for this year's transactions to be added on to it, or to be adjusted for it. Receivables last year is the brought forward figure in receivables this year, and then we're recording the invoices and the payments and the discounts allowed and the credit notes. So last year's closing position is this year's opening position. And if last year's position brought forward is incorrect, and I don't see how it can be on a computer, but if it's brought forward incorrectly, that could have a material impact on this year. The comparatives, last year's figures, are shown on this year's financial statements. They should be the same. There's no excuse for having something disclosed last year on the balance sheet or on the income statement and a different figure shown this year. There's no excuse for that. And again, on a computer program properly written, tested and applied, a computer program would not allow that to happen. And the appropriate accounting policies consistently and relevantly applied. Audit work required. How are you going to confirm as auditors that the opening balances in this year's general ledger, this year's impersonal nominal ledger, how are you going to confirm that those figures are in accordance with last year's closing figures? You get a copy of the balance sheet and you get a printout of the opening trial balance. What about consistent accounting policies have been used, or that any change of policies correctly dealt with in accordance with IS 8? How do you confirm the consistency of the application of and the disclosure of the accounting policies?
By written information.
By looking at Note 1, which is accounting policies, to a set of financial statements, by looking at Note 1, you sit there with this year's Note 1, and you've got next to it last year's Note 1, and you don't even have to read it. You just see that it's the same. It would be unusual for a word to have changed, and if a word has changed, it's unlikely that it's changed for the same length word. So where in this one the third line ends with the word issued, last year's the third line should end in the word issued. And the 15th line ends in the word economic, and it should be the same right the way through. It's a quick and easy task. It's a task that you can give to the lowest of the low in terms of experienced members of the audit team. The school children who are here just to spend their Easter holidays helping mum do her work, they can do that job. That's so easy. Check the comparisons have been properly disclosed by checking them against last year's financial statements. Again, you've got the two books side by side, just open, compare them. It's so straightforward. New clients, we did quite a bit of new clients yesterday, didn't we? But this is the auditing implications of having a new client. Additional procedures are required due to the fact that we didn't audit it last year, so we can't bring in, look at last year's file, we can't do it. Well, actually you can. Because in an exam you can say, because it's a new client, last year's file is not available, so additional procedures are necessary. So you can bring that in. Another thing you can bring into many auditing answers is, we've said it, although we've only said it as the one word, it's ask. Ask management, or ask relevant personnel. Discussions with management. Now one thing you need to be aware of here is, look at last year's file, it's not going to score anything. Or discuss with management is not going to score a mark. It's merely the introduction to an idea. So look at last year's file and take from last year's file the schedule of finance leases, and then compare the schedule of finance leases this year with last year to see if there are any new ones or if any have now been paid off. So it's a mere starting point. Discuss with management. Discuss what? Discuss what? The fact that the Republic of Ireland lost the second goal against Austria on Tuesday night and in the last 30 seconds. What are you discussing with management? The weather? So you've got to use the introduction words, discuss with management the possibility that, or confirm with management that full disclosure has been made. It's not enough simply to just put that bold statement that says discuss with management. Another one you can bring in often into auditing answers is the internal auditors. Something is a mental process you should go through, that when you're looking at writing or planning an audit answer, there should automatically go through your mind, can I bring in last year's file? Can I bring in internal auditors? Can I bring in discussions with management, in order that you can make an additional point? And that additional point is worth marks. That additional point is worth 500 or 600 places. You're going to overtake 500 or 600 people if you can get that additional point. Because when you think about a normal distribution of people around the 50% mark, one more mark is going to overtake a substantial number of the opposition. And that's what you're doing. You're trying to beat the opposition. I said this once to a group of students, and they said, it's not a competition, it's not a competition. It is a competition. It is. Because if there's a marginal decision about, is it going to be you that passes or is it going to be them that passes, and you've got one more mark than they have, then it is a competition. And treat it as that. Because there is a limit. You will never have a 100% pass rate. We'll never, ever, in any exam, will have a 100% pass rate. And therefore, you've got to make sure that you're better than, in this paper, you've got to make sure you're better than 69% of the rest of the population. 69%. Included within that 69%, there must be a substantial number of Big Four auditors. There must be. And if that's the case, if the 31 or 32% are Big Four auditors, then it means people like all of you who work in manufacturing or don't work in auditing, it means that you're not passing, but of course you are. So it's not just the 69 or 68%, or should I say it's not just the 31 or 32%, they're not entirely Big Four auditors, Big Four firm auditors. There are a lot of other people. And I've said in the past, it's often a negative implication to work for a Big Four auditor when you're thinking about trying to pass the auditing exam. There are people in this room who struggled with F8 and work for Big Four auditors. And on that basis, you cannot rely simply because I am an auditor, therefore I shall pass the audit exam. You can't rely on that. And it's just a question of making one more point, scoring one more mark, giving the marker one more opportunity to give you one more mark. And that's what's going to get you through. And that's why planning is important. That if you see a 4-mark part of a question, you've got 4 points to make. It's no good making 2, because you're only going to score 50%. And if one of those is not, the marker doesn't like one of those, you're only scoring 25%. And it comes down clinically, cold, clinical approach to exam answering. Identify where the marks are and target your answer to get those marks. No one write 5 pages for a 4-mark question. You'll get all 4 marks, but you lose all the marks that you've taken the stolen time from. Let's get on to new clients, page 43. I've just said that last year's file is no longer available. You will get some assistance from last year's auditors. They should provide you with meaningful and relevant information from the end of last year, but you can't have a look at their file, and they have no obligation to show you their file. What we can do, though, is we can consult with management. What about? Well, about the reliability of last year's financial statements. Consult with management about, has anything come to light since last year's financial statements were filed with the government? Has anything come to light that puts a shadow of doubt upon those figures? Review of the client's records, working papers and systems details for the previous period. The client's records. The client's records, not the records of the previous auditor. Look at the client's records of working papers and systems. Audit work on the current period will go some way towards confirming the reliability of last year's figures. Again, I'll go to receivables or inventory or payables. Those are the three obvious ones. If you schedule your audit work or plan your audit work to cover the early months of this year, they will give you a degree of confidence about the reliability of last year's closing figures. If you're looking at the cash receipts or cash payments at the start of this year, these are last year's receivables paying us money, or us paying money to last year's payables. And that will give you a degree of comfort about particularly the current assets and current liabilities. Consultations with the previous auditors, there's no legal obligation or ethical, it's not ethical necessity, but there is a professional requirement that the transition from one firm of auditors to another should be made as smooth as possible. The client's interests are of major importance, of paramount importance. And so they hopefully, sensibly, would be willing to assist, explain, provide you with any information which is vital, which they haven't already provided you with. So you may get some assistance from last year's previous auditors. In exceptional circumstances, and it's truly exceptional, in exceptional circumstances you may have to conduct a balance sheet audit on last year's figures to confirm the figures brought forward, to confirm last year's closing position. But that has to be an exceptional circumstance. It's already been paid for. Then your new client has already paid an audit fee to the previous auditors, and now you're saying, we don't like these figures, we want to do it again. So will you pay us again for the same audit for the 2011 figures? Qualification in the previous period, these are particular problems. If last year's audit opinion was qualified, then this year it's our client for the first time. If the matter has been resolved, if the matter which gave rise to last year's qualified opinion has been resolved, and it's been properly dealt with and properly explained within this year's financial statements, then there's no qualification, no modification is required. There's no additional work necessary. If it hasn't been resolved, and it is still material, then it will give rise to a qualification in this year's audit opinion as well. But it may be appropriate to say that we're going to qualify on the basis of we disagree with an amount or there's a limitation of scope, but this occurred last year as well. So you can identify that it's a last year problem brought forward into this year. But you have to consider materiality. It was qualified last year on the basis it was material. This year things may have changed. It may still be the same figure. It may even be an increased amount. But in the concept, applying the concept of materiality, it's immaterial to this year's figures, in which case it's not mentioned. Even though it's not a resolved problem, it wouldn't be mentioned. So there we go. If the matter has not been resolved and it is material to the current period, then we will need to qualify. The audit report should refer to the fact that the audit report on last year's financial statements was qualified on the same problem. The auditor is required to give an opinion on truth and fairness of the financial statements. These comprise a statement of financial position. I've said the statement of comprehensive income there because it's available to produce a statement of income and statement of comprehensive income as just a single document. The alternative is to have a separate statement of income. The bottom figure is then the opening figure for the statement of comprehensive income. So it may be two separate statements. You may want to just adjust those notes. I'm going to leave them because I can explain why I've only put the one there. The statement of cash flows. Total recognised gains and losses is the UK equivalent of our statements of changes in equity. The notes to the financial statements and other matters identified as being part of the financial statements. There is endeavour, you will see in the Remuneration Committee's report, you will see the second paragraph on page 28. As required by legislation, we split the remuneration report into two parts, one that contains unaudited information and the other containing audited information. The company's auditors are required to report on the auditable part of the remuneration report and state whether in their opinion that part has been properly prepared in accordance with the Companies Act. And if I now turn to the audit report on page 81, then they do explain opinion on other matters. As in our opinion, the part of the remuneration report to be audited has been properly prepared. Information given in the director's report for the financial year for which the financial statements is prepared is consistent with the financial statements. So they're looking for inconsistencies and misleading statements. And finally, the information given in the corporate governance report set out on pages 22 to 27 with respect to internal control and risk management systems and about share capital structures is consistent with the financial statements. These are matters on which they are required to report, but they're not part of the financial statements. So I'm down towards the bottom of page 43, back in the course notes. Other information often included in an entity's annual report with the financial statements, you'll find the director's report or management commentary, the chairman's report, maybe 5-year summaries. Key performance indicators is not in that list, but key performance indicators. Corporate governance report, corporate social responsibility report. These are items, you can find them in the Devro accounts. I noticed that none of you took the Devro accounts home with you last night. I was a bit, shall I say, disappointed. You found alternative ways of passing your evening rather than reading a set of Devro accounts, but that's up to you. You've still got 10 weeks before the exam. Is that for me?
Sorry.
It's not for me. Audit opinion is not given on these items, but the information could include details that are misleading or inconsistent, and they may serve to create doubt about the financial statements. There clearly has to be consistency between these other matters and the financial statements. We should read the other information, read it, review it, particularly looking for misleading statements and inconsistencies. And again, in the audit report of Devro, they do say matters on which we are required to report by exception. And some of those are misleading statements. Where is it? I thought I'd seen it. Yeah, it's in the scope paragraph. In addition, we read all the financial and non-financial information in the annual report to identify material inconsistencies with the audited financial statements. If we become aware of any apparent material misstatements or inconsistencies, we consider the implications for our report. So this is what they do. They're looking for inconsistencies and misleading statements. Statements which are not related. They're about matters which have no direct relationship with the financial statements, but which are misleading. So what does the word inconsistent mean? What does the word inconsistent imply? It implies two things are being compared. And you can't be inconsistent without being inconsistent with something else. So inconsistencies are comparison of other information compared with financial statement information. A misleading statement is, within this other information, a statement which has no direct relevance to the financial statement information, but is in itself misleading. So, maybe in the chairman's report, the chairman may say there has been a rapid growth in the demand for sausage skins in Burkina Faso, but there's got absolutely nothing to do with whatever is in the financial statements. And when you look on Google or another search engine, when you look on the internet, you discover that sausages sold in Burkina Faso, there were only 30 sausages sold, but that was an increase from 20 sausages sold the year before, so a substantial increase. Yeah, but it's misleading, isn't it? It's giving the wrong impression. So that's what misleading statements are. Audit opinion is not. Auditors should read, we've done all that, page 44. If after discussion with the directors, now when you find an inconsistency, particularly an inconsistency, when you find an inconsistency, it's either the other information which is wrong, or it's the financial statements which are wrong. They can't both be right. If there's an inconsistency, one of them is wrong. And hopefully it's the other information which is wrong. If it's the financial statements that are wrong, then we may have to do additional work. If it's material, and still, whatever, we have to resolve that inconsistency. So we discuss with the directors, we point out the inconsistency, we persuade the directors to change. If it's financial statements, if it's a material alteration, then that's going to involve us in more work auditing that material alteration. Hopefully it won't be, because we should have found it in the first place. So the financial statements themselves should not be wrong, and therefore it must be the other information which is wrong when compared with the financial statements. So we persuade them to change them, and if they refuse to change them, then we have to mention that within our audit report. That same paragraph at the top of 44. If the other information requires amendment and it's not made, the appropriate action will depend on the item which contains the inconsistency or error. We should seek legal advice. And at an extreme level, if they still refuse to sign, then we should consider resigning. Subsequent events, defined as those events occurring between the end of the reporting period and the date of the auditor's report, and facts discovered after the date of the auditor's report. There has to be a line drawn, because if you think about it, otherwise every event after that first year end, every event is subsequent, because it's subsequent to that previous year end. So it doesn't matter if it happens on the 3rd of January or the 24th of October, it's still subsequent to the previous year end. So you have to draw the line, and the line is drawn here, the line is drawn at the date of the auditor's report. So we need to consider material events which have happened in the context of the client up until the very last minute when we are when we're arriving at our audit opinion. And after that, well, we should bear in mind, if something comes to light after we've signed our audit report, but before the general meeting, then we need to consider what we should do. If it's material, then there is the possibility that we may actually withdraw our audit opinion and replace it with another. Ideally, what would happen is we would withdraw our audit opinion, we would persuade the directors to withdraw their approval, make the adjustment as a result of the subsequent event if it is an adjusting subsequent event, and if it's not an adjusting subsequent event, then make the disclosure in the disclosure note, reapprove the financial statements, the auditors express their opinion, we get them reprinted. Can you imagine the costs of printing thousands of Devereux's accounts at 92 pages long? Get them reprinted, send them out to the shareholders again, because we've already sent them 3 weeks before the annual general meeting. Phenomenally expensive. And if the directors are not prepared to do that, what would you do? Ask them why. Why? Because it's expensive. Well, that's not an excuse. I'm sorry, but that's not an excuse. And if they still refuse to amend, then you exercise your right to attend to the general meeting. And you attend, and it comes to the acceptance or the presentation of the financial statements, and you jump to your feet and you say, "Excuse me, Madam Chair, may I interrupt you here? You shareholders, you members present don't know me, but I'm a representative of the auditors, and we are withdrawing our audit opinion. And the reason we are withdrawing," and you'll explain to the members who are present why you're withdrawing your audit opinion. I have never, ever heard of that happening. I have never heard of a single instance of that happening. But it is your right to attend, speak, and be heard at the annual general meeting of members. But I've never heard it happen. Okay, give me 3 examples of subsequent events. This should not stretch your mind in any way. Give me 3 examples of subsequent events.
Bankruptcy of main customer.
The bankruptcy of main customer, yep.
case.
Yep, losing a legal case, or the outcome of a legal case may win it. That would be a subsequent event as well. So the outcome of the successful conclusion of a legal action, either for or against us. Another one?
Not evaluation, but maybe the change of value of your stock.
Which could arise as a result of change in legislation, for instance. So we have a stock line, our major stock line, and legislation has now been passed. But the process of passing legislation is a long-winded process, and we ought to have known about the possibility before. So stock ought to have been written down before then. Well, you're right. I mean, it is a theory, but in practical terms, change in legislation would not normally have a subsequent event implication.
Because of fire?
Yeah, fire, flood, disaster, earthquake, volcanic ash. When Ijaf Jalajokal exploded, that was a subsequent event so far as your local airline was concerned. They lost. In fact, I think that was one of the factors that destroyed your national airline, wasn't it? Oh, well, was it Air Baltic that destroyed you? Air Flick? I think Air Flick had something to do with it. No? But yeah, natural disasters, tsunamis and fires, floods, tempest, inclement weather, unusual weather could have a subsequent event. That we're scheduled to be delivering something and we're unable to deliver it, and therefore in breach of contract, and now we're being sued. And so you can have all sorts of inclement weather. That probably wouldn't be a good example because acts of God tend not to be actionable. So if it's inclement weather which prevents us from completing a contract, then we will probably be protected. Okay, subsequent events, increase in interest rates could have a subsequent event implication, because the increase in interest rates would affect cost of capital, which affects discounted cash flow, so anything which has been discounted will then give rise to possibly material changes in figures, possibly. Local banking collapse, that doesn't tend to happen here, I know, but Cyprus again, local banking collapse or sequestration of assets. Poor Russians, all those poor Russians who've got their money invested in Cyprus and are about to lose 40% of their investment, over 100,000 euros. Don't you feel sorry for them? Yes, we do. Yes, we do. Auditors should perform procedures designed to provide sufficient appropriate evidence that all material subsequent events up to the date of the audit report which require adjustment of or disclosure in the financial statements, we want to make sure that they've been fully identified and properly accounted for. How do you audit the completeness of the disclosure and the correct adjustment, the correct reflection within the financial statements? How are you going to identify the completeness of subsequent events? Ask the management. Talk to the management of the company and the internal auditors, and maybe even the audit committee. Discuss with those charged with governance. Discuss with those charged with management. The internal auditors, discuss with them the possibility that subsequent events may have occurred of a material nature, and they really ought to be made aware. But it's no good asking management, because if you ask management and they say, yes, we've told you all the subsequent events, that's not going to speak for itself in a court of law, is it? So therefore, having asked them and got the response, written representations, you'd then get them to confirm in writing formally that they have made full disclosure to you of all subsequent events of a material nature, and they feel that they've properly accounted for them. I think I've covered the rest of that page. I've not covered particularly the audit procedures. All I've said is discuss with management, but we need to do other things as well. Discuss with management, sure. Discuss with management the possibility that subsequent events may have occurred and we should have been made aware of them, what other audit procedures would you carry out in order to confirm the completeness of that disclosure? What else would you look at, or who else would you talk to?
Interim financial statements, maybe.
The
Interim financial statements.
interim financial statements. What, this year, subsequent to last year's interim financial statements?
No, this year's.
This year's interim financial statements.
As if we audited last year.
He's going to tell us about subsequent events that happened the year before.
No, if we audited, let's say,
If we-
financial year 12,
Yeah.
so we will look at the 13th year interim financial.
So you're going to look at the June financial statements in 13 to tell us about subsequent events in 12. Yeah?
For 12.
For 12. Yeah, okay. Now in the UK, and I don't know, I have a feeling I know what happens here, in the UK, public companies have to file their accounts within 6 months of the year end. So interim financial statements will not have been prepared by the time we're filing those accounts.
So maybe 12.
But what you could look at is management accounts. You could look at the monthly management accounts of January, February, March, in order that those management accounts and that management information will reflect the subsequent events from December, and that will be before you've committed your audit opinion, and therefore you should be able to, yeah, okay, I'll accept management accounts. Interim was a nice effort, but I don't think it's appropriate. But management accounts for the period subsequent to the year end and up to the date of the auditor's report. Something else?
Board meeting minutes.
Yes, certainly. That's another. Board minutes is something that you can get into. This is now 4, I think, isn't it? Board minutes is something you can often get into auditing answers, and it's something which you should be automatically thinking of. Board minutes, internal auditors, discussions with management on last year's file. You've now got 4 potential mark earners. We only need another 46. So board minutes, it may or may not happen in practice, and particularly not now in terms of emails and internets and instant communications. But certainly when I was a trainee, it would not be unusual for a client to have a correspondence file. And on the correspondence file would be all the letters that the client has sent or received, and one of the things we used to do was read through the correspondence file. So skip through it, not read every word of every letter, but skip through it, and particularly read the heading, the subject heading of the letter, because that gives you an idea of what the letter is about. In an exam, I see no reason why you shouldn't bring the correspondence file in. You may never have seen one. You may, in those of you not auditors, may never have seen one, or you may have one within your companies. A copy of every letter that you've sent out and that you've received. But why not introduce it into the exam, a correspondence file? Review the correspondence file for the period subsequent to the year end, to determine if there's any material matter which has been raised, and particularly things like letters received from customers who were complaining about the quality of the client's products, because that then raises the question about the valuation of the inventory at the year end, that if the product is faulty, then the inventory is potentially worthless. Correspondence files from liquidators appointed to customers' companies would give you information about the recoverability of the receivables. What else might you do? I think a letter from the solicitor to confirm that there has been no change in the situation of the ongoing legal action. Maybe, although I think I'm stretching a point here, maybe a review or confirmation that no new law has been passed which affects the client. I'll come back again to the point that I raised earlier. Law doesn't get passed instantly. It's not an overnight thing. There was one relatively recently in the UK, and it's about inventory as well. We used to have a children's toy. I don't know whether I told you this at F8. There's a children's toy. It was a little ball on an elastic, and there was a little plastic ring, and you put your finger through the plastic ring, and you could throw the ball, and it would elastic back to you, and you'd catch it. And now, how long can you do that before you get bored of doing that? After about 5 minutes, what else can I do with this toy other than throw it and catch it when it bounces back to me? So children worked out that they could spin it around like this and spin it around in a vertical axis, and it would bounce off the floor and it would fly all over. And then some children decided we could actually make a helicopter out of it and spin it around on a horizontal axis. But of course your arm gets tired, so your arm comes down and this ball whizzes around your neck and the elastic tightens, and there are children going blue in the face. I don't think there were any deaths. I don't think there were any. But children are being rescued by mothers rushing out with kitchen knives, cutting the elastic so that the child doesn't get strangled. There was an emergency law passed that said this is an illegal toy. This is a dangerous toy. Another thing we had was something called clackers. A little plastic handle and 2 strings and a hard plastic ball at the end of the 2 strings. And if you lifted the little handle up and then brought it down quickly, the balls didn't fall as quickly as your hand went down, so your hand would overtake them and they'd clack at the top. And then if you brought your hand back up, so you could go clack, 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 like that. Did you have them here? Did you? They're dangerous as well. People with broken wrists and oh yeah. Do you still have yours? You no longer play with them, I presume? No. So emergency law does get passed, but it's a rare occurrence that a law is passed sort of within 2 days of being requested. So there possibly would be a legislation change subsequent to the year end which might have an effect on the valuation of assets. Going concern, page 45, when forming an opinion as to whether financial statements give a true and fair view, we need to consider whether the company has the ability to continue as a going concern. Can you define going concern? Can you give me a definition?
The entity's ability to operate in the foreseeable future.
It's the ability of the company to continue its operations into the foreseeable future with neither the intention nor need to close. Foreseeable future?
1 year?
Yeah, it's 12 months, the next year end, or it's 6 months after the date of the audit report, whichever is further into the future. So it's either 6 months after the date of the audit opinion, or it's the next year end, but typically it will be the next year end. If the going concern assumption does not apply, what's the impact on a set of financial statements? If the auditors have decided and looked at the situation and considered in depth and very carefully that the company actually is not a going concern and it does have the necessity significantly to curtail the scale of operations.
Should be restated. Should be restated.
Yeah, they should be restated on a break-up basis. The accounts are prepared. It's a fundamental concept of financial statements that the going concern concept does apply, that the company will be able to continue in the foreseeable future with neither the intention nor need significantly to curtail the scale of operations of the entity. What does curtail mean? Curtail, C-U-R-T-A-I-L. To curtail. To curtail is to cut short or cut back. To curtail the scale of operations of the entity means to significantly reduce the operations that the company is carrying on. So the implication of the lack of the going concern applicability is that, as you've already said, it means that the financial statement should be restated on a break-up basis rather than on a going concern basis. And the implication or the impact of that is that all your long-term assets now become short-term. So instead of historic costs, less accumulated depreciation and impairments, you're now going to value them as current assets at the lower of cost and NRV. All your intangibles are likely to disappear. What's the value of, or certainly need to be brought down to market value. What's the value of a brand when a company is in liquidation? What's the value of goodwill when a group is facing liquidation? So all your long-term assets now become short-term. Your long-term liabilities become short-term liabilities. The loan repayable in 2019 now becomes instantly repayable. The building that you had, which you'd used as security for the loan, is now of nil value. It just gets set off against the loan. The debenture holder will exercise their right, and the building is no longer yours. There are additional expenses to take into account. Redundancy costs. You're going to have to make your workforce redundant. So you're going to have to pay redundancy costs as a liability. Creditors will appear out of the woodwork, people claiming that you owe them money. And debtors, receivables, will disappear into the woodwork, saying, no, we've paid. So the recoverability of your current assets can now be heavily questioned. What's the value of your inventory if you're no longer a going concern? There are people who specialise in this. In the UK, they buy liquidated stock. They hear of a company going into liquidation, or an accountancy firm, the liquidating partner of an accountancy firm, will contact these people and say, I have a stock of electrical fittings, the company is going into liquidation, come and value them and make me an offer. And the offer that these people will make could be as low as, I don't know, 30%, 40% of the retail value. And they'll just buy the whole lot and take it away and then sell it for 60% of the retail value and make for themselves 100% profit. There are people that do that. They buy liquidated stock. They specialise in that activity. So the value of your current assets will be severely reduced. Responsibilities. The directors and auditors' responsibilities. It's the director's job to determine whether the company is a going concern, and they will state so. We have prepared the accounts on the basis that the company is a going concern. The auditor's responsibility is to satisfy themselves that the going concern concept is still applicable. So we'll make inquiries, and the previous bullet point, responsibility to satisfy them that it's still appropriate and that its use has been adequately disclosed. We should make inquiries of the directors, ask the directors how many times. You don't have to say ask, you could say communicate or correspond or discuss or liaise, or you have all sorts of ways in which you can use the same concept of discussions with directors. Should make inquiries of the directors and examine appropriate financial information. Also plan and perform procedures designed to identify material matters which could indicate doubt about the entity's ability to continue. Give me 5 factors which might cause you to believe that going concern is not appropriate. We need to consider splitting these between financial and non-financial, and internal and external. So financial internal indicator, which might suggest that we're not a going concern.
Current assets are lower than current liabilities.
Yeah, current assets less than current liabilities. That may be by a conscious decision, that we don't need the current assets because our stock turnover is so fast that it's not a problem. My next door neighbour, when I lived in England, was a wholesaler of fruit and vegetables, and his current assets, his inventory was nothing. It was fresh fruit and vegetables. So at the end of the year, his inventory was minimal, and he worked from a market. Well, when was the last time you went to the market and said, can I have 2 kilos of potatoes and can you put it on my account? Can I buy it on credit? It doesn't happen, does it? So he had no receivables, he had no inventory. He had a load of cash until his son stole it all and gambled it on wine, women and drugs. So he had no current assets. But he bought his fruit and vegetables on credit from the bigger wholesalers in Manchester, and he didn't pay them for 60 days. He had 60 days worth of free credit. It didn't cost him anything. He had no inventory, 60 days worth of profits, out of which he then starts paying the creditors. So it could be, depends on the nature of the business, but it could be that current liabilities normally are greater than current assets. Admittedly, there should have been cash, But as I say, his son stole it and burnt it. In fact, he used to drive a Rolls Royce, this man. He had an outdoor swimming pool next door to where I lived, heated. And I would stand in the snow in the winter looking over the fence at steam coming up off his outdoor swimming pool. He was so wealthy that he could afford to keep it heated throughout the year. And he drove a Rolls Royce, and his wife drove a soft-top convertible Mercedes. Each of his 5 children had a car. 8 grandchildren went to private school at phenomenal. It was a tremendously valuable business. And his son stole all the cash. He had to go to liquidation. He had to sell his Rolls Royce. The house, he had to sell that. What a disaster. Poor man. The wife had to sell a car.
You're acting like Lithuanian people.
No, I'm not acting like I'm not acting like your compatriots at all. It's just that he actually did tend to rub his wealth in my face. No, I can't feel too sorry for him. 5 factors. Yeah, okay. What about loans? Loans coming scheduled for repayment in the foreseeable future, and an inability to obtain replacement finance. That will be an internal financial one as well. And if we have a deficit balance on retained earnings, then we're probably going therefore to have a share price, a share valuation, which is lower than nominal value because the company's struggled, and in that situation we will be unable to raise further finance by a further issue of shares, because nobody's going to pay me $1 per share when the market value of that share is less than $1. The financial external, that was financial internal. What about financial external? Yeah, your major customer has gone into liquidation. That's a financial external. Your major customer has gone into liquidation. Or penalties and fines have been raised against the company because of breach of local regulation about land contamination, for instance. So you're in breach of that, and you're now facing penalties and fines. Those are financial ones. There are lots and lots of others, and just doesn't seem to be sensible for me to spend the rest of the day going through alternative possible indicators of going concern problems. But what about the non-financial indicators? Non-financial internal.
Pure reputation.
Yeah, loss of, well, I'm going to say loss of reputation, but now I'm going to extend that. I'm going to say loss of anything. Loss of franchise, loss of key staff, loss of patents, loss of premises. Somebody's taken our premises back from us. Breakdown of computer systems without sensible backup having been taken. It's a loss of anything, really. And external non-financial, well, it's the tsunamis and floods and inclement weather. Non-financial external would be Eyjafjallajökull, the Icelandic volcano. That was an external non-financial. Or the bombing or the destruction of the World Trade Center. That's a pretty good indicator of a company no longer being a going concern. So on page 46 now, evidence available. The planning stage. Here we go again. At the planning stage, the auditor would wish to assess the risk that the company may not be a going concern. There's no question that Devro is a going concern. There's no question at all. If you're making £273 million worth of sales and £43 million profit, they're not facing problems at all. But as part of the planning process, the question must be asked, is the client a going concern? Are there indicators to suggest that going concern is in doubt? We'll do this at the planning stage through obtaining a thorough knowledge. Again, the use of this expression, the auditor should obtain a thorough knowledge. This is another thing which you should be able to get into auditing answers. The auditor should obtain a thorough knowledge. Discuss with internal auditors, discuss with management, look at last year's file. What was the other one we had? Minutes, board minutes. So a number of almost standard things that you can use to raise a valid point in an auditing answer. They obtain a thorough knowledge of the business, its products, the environment it operates in. Also assess the controls to help us decide how much confidence we should have in forecast data. And then finally, analytical procedures can help us identify potential problems. One of the things we should do, if there are going concern indicators sufficient to give us cause for concern, is we should ask for the cash forecast that the company should have prepared, the cash projections that the company ought to have prepared. They too should have realised that they're facing problems, and the way to resolve it is to try and forecast where we're going to be in 6 months, 12 months' time, 2 years' time. Get a copy of that cash forecast and look at it, particularly looking for the completeness, to see that all cash outflows have been taken into account. It's easy, for instance, to overlook the tax payment because it's a one-off payment at the end of the year, or 9 months after the year end. Look at the assumptions which have been made in the cash forecast and determine whether or not they're reasonable assumptions for the preparation of that forecast. Look at the worst forecast position. If it's forecast that at the end of August we're going to be 2.3 million overdrawn, and we only have a 2 million overdraft facility and the bank has indicated that's it, then we can see that at the end of August, unless we can change the forecast, unless we can change actuality before the end of August, we're in deep, deep, deep trouble. So matters to consider when looking at the cash forecast, looking at the completeness of it to make sure that all cash outflows particularly have been included, and that cash inflows are predicted on a prudent and careful and non-optimistic basis. Audit report implications, where we consider that there are doubts, well, you can finish up with all sorts of audit opinions here, audit reports. You can actually give it an unqualified opinion. It could come up as a clean opinion that says, yes, the financial statements do show a true and fair view. Because if we think the going concern concept doesn't apply, and the directors have agreed with that, and they have prepared the financial statements on a break-up basis, then they do show a true and fair view. So you can finish up with an unqualified opinion. You could have an emphasis of matter. You could say, yes, they do show a true and fair opinion, but we draw attention to note 1 and the accounting policy note that the financial statements have been prepared on a break-up basis. So it could be an emphasis of matter with a clean opinion. It could be uncertainty, it could be limitation of scope, that you don't have enough information about material areas to give you sufficient appropriate audit evidence for you to issue an opinion, and therefore you've got this uncertainty. Except for any adjustments which might be necessary, the accounts do show a true and fair view. The applicability of the concept is material, but we can't be certain. And if it's pervasive uncertainty, and it probably would be, if it's a pervasive uncertainty that the whole of the financial statements are now meaningless because we're not able to determine, because there's a lack of evidence available, then you'd have to come up with a disclaimer. If you are of the opinion that going concern is not applicable, and the directors agree, and they've prepared them on a break-up basis, but one of the break-up valuations you disagree with strongly, and it is material, then you give an except for a material disagreement. But in all other respects, on the break-up basis, the financial statements do show a true and fair view on a break-up basis. Or if you maintain that the financial statement, that the company is not a going concern, and the directors say, yes, it is, and you're quite certain in your own mind that it isn't, then that will be a pervasive disagreement. So you've got 6 potential audit opinions, audit reports. You've got 6 potential audit reports. We've got unqualified, we've got unqualified with emphasis of matter, we've got material and pervasive, uncertainty and disagreement.